What if I told you that Japan's greatest economic disaster didn't begin with a market crash, not with a war, not even with corruption, but with a single handshake inside a luxury hotel room? In the 1980s, Japan was unstoppable. Its economy was growing faster than almost any nation in history. Japanese companies were buying American landmarks. Tokyo real estate was worth more than entire countries. Analysts openly predicted Japan would surpass the United States as the world's #1 economic superpower. And then, almost overnight, everything changed. Growth collapsed, stock markets imploded, property prices evaporated, an entire generation lost economic momentum. What followed became known as Japan's lost decade, a crisis so severe that it actually lasted more than 20 years. But here's the mystery most people never ask. How did the strongest economy on earth fall apart? Without a war, without sanctions, without a natural disaster. The answer leads us to a secretive international deal, pressure from global powers, and a chain reaction that no one could fully control. And the most disturbing part, the same pattern is quietly repeating today. Let's go back to the beginning. To understand the collapse, you first need to understand how powerful Japan became. After World War II, Japan was in ruins, cities destroyed, industry wiped out, poverty everywhere. But instead of collapsing permanently, Japan rebuilt faster than anyone expected. By the 1960s and 70s, Japan entered what economists call the Japanese economic miracle. Factories expanded, technology exploded, automobiles, electronics, machinery. Japan dominated global exports. Companies like Sony, Toyota, Honda, Panasonic, and Toshiba became household names worldwide. By the early 1980s, Japan had the second largest economy on earth. Its trade surplus with the United States was massive. Japanese products were flooding global markets. And Japan's currency, the yen, was relatively weak, making exports extremely competitive to Americans and Europeans. This looked dangerous. The U.S. economy was slowing. Manufacturing jobs were disappearing. Trade deficits were growing. Politicians needed someone to blame, and Japan became the target. In the early 1980s, the United States was running huge trade deficits, especially with Japan. American officials accused Japan of manipulating its currency, flooding markets with cheap exports, weakening American manufacturing. Pressure began building behind closed doors. Washington wanted Japan to strengthen its currency. Why? Because a stronger yen would make Japanese exports more expensive, slowing Japan's dominance and helping U.S. companies compete again. But Japan faced a dilemma. If they refused, they risked trade wars and political retaliation. If they agreed, they would damage their own export-driven economy. That tension led to one of the most important financial meetings in modern history. September 22, 1985. Five of the world's biggest economic powers met at the Plaza Hotel in New York City. United States, Japan, United Kingdom, France, West Germany. Behind closed doors, they signed what became known as the Plaza Accord. Officially, the deal aimed to weaken the US dollar and strengthen other currencies, especially the Japanese yen, to reduce America's trade deficit. In simple terms, Japan agreed to allow its currency to rise dramatically in value. At the time, it sounded reasonable, cooperative, diplomatic, but this decision would unleash consequences nobody fully predicted. They feared recession. They feared unemployment. They feared losing the economic momentum they had built for decades. So they made a second critical decision, one that would quietly plant the seeds of disaster to offset the damage from the strong yen. Japan's central bank took aggressive action. Interest rates were slashed. Borrowing became cheap. Credit became abundant. Money flooded the economy. The logic was simple. If exports slow down, stimulate domestic spending. If companies struggle, make loans easier. If growth slows, inject liquidity. At first, it worked. Businesses borrowed aggressively. Consumers spent more. Investors rushed into markets. But cheap money doesn't just stimulate growth. It inflates bubbles. And Japan was about to experience one of the largest asset bubbles in human history. With low interest rates and unlimited credit, Japanese banks began lending aggressively. Not just to businesses, but to real estate investors, stock speculators, and corporations using assets as collateral. Land prices exploded. stock prices skyrocketed. By the late 1980s, Tokyo real estate was valued higher than all property in the United States combined. The Nikkei stock index nearly tripled in less than 5 years. Office buildings were being flipped for massive profits. Companies borrowed money simply to buy stocks and land. People believed prices would never fall. Banks assumed collateral values would only rise. Everyone felt rich. And that illusion became the most dangerous part of all. When asset prices rise rapidly, behavior changes. Risk feels invisible. Debt feels harmless. Speculation feels normal. Japanese corporations stopped focusing on productivity and innovation and started focusing on asset trading. Households took massive mortgages believing property prices would always rise. Banks approved loans without proper risk checks because collateral values looked unstoppable. Even government officials began celebrating the bubble as proof of Japan's dominance. But underneath the surface, the economy was becoming fragile. Growth was being powered by debt, not productivity. Wealth was being inflated artificially, not earned sustainably. Stability was being replaced with speculation. And then came the breaking point. By 1989, inflation fears began rising. Asset prices were out of control. Speculation was extreme. The central bank realized they had created a monster, so they reversed course. Interest rates were raised sharply, credit tightened, loan approvals slowed, and suddenly, the fuel powering the bubble disappeared. What happened next shocked the world. In early 1990, Japan's stock market collapsed. The Nikkei index lost nearly 50% of its value within months. Real estate prices followed. Land values plunged. Property markets froze. Loans turned toxic. Companies that had borrowed heavily using inflated assets as collateral were now underwater. Banks were stuck holding massive amounts of bad debt. The illusion of endless growth shattered. But this wasn't just a normal recession. It was something far worse. It was the beginning of a long economic paralysis. And here's where the story becomes even darker. Because instead of recovering quickly, Japan entered a slow-motion collapse that lasted decades. Businesses stopped investing. Consumers stopped spending. Banks stopped lending. And government rescue plans only made things worse. When Japan's bubble finally burst in 1990, most people expected a normal recovery. Markets fall. Governments respond. Economies rebound. That's how it usually works. But Japan didn't rebound. Instead, the country entered a strange economic nightmare, one that defied traditional models. Stock markets never fully recovered. Real estate values kept falling. Consumer confidence collapsed. Business investment froze. And what made it even worse, the damage wasn't visible all at once. It unfolded slowly, silently. Year after year, a collapse without explosions, a crisis without headlines, a disaster that drained momentum from an entire generation. This is how the lost decade truly began. At the center of Japan's crisis was its banking system. During the bubble years, banks had issued enormous loans backed by inflated real estate and stock assets. When prices collapsed, those assets lost value overnight. Suddenly, banks were holding non-performing loans, debt that borrowers could no longer repay. But instead of admitting losses, Japanese banks did something dangerous. They hid the damage. They rolled bad loans into new ones. They delayed write-offs. They avoided bankruptcies. Why? Because acknowledging losses would expose massive insolvency. So Japan created what economists later called zombie banks and zombie companies. Businesses that should have failed were kept alive artificially. Banks that should have restructured were protected politically. The result? An economy filled with weak institutions dragging down growth. Money stopped flowing to productive companies. Innovation slowed. Risk-taking disappeared. The financial system became frozen. Then came another silent killer, deflation. As demand collapsed and asset prices fell, prices across the economy started declining. At first, falling prices sound good. Cheaper goods, lower costs, more affordability. But deflation is poison. For debt-based economies, here's why. When prices fall, consumers delay spending. Why buy today if it'll be cheaper tomorrow? Businesses reduce investment because future profits look smaller. And worst of all, debt becomes heavier. When wages stagnate but loan amounts stay fixed, repayment becomes harder. Japan entered a vicious cycle. Low spending gives falling prices gives weaker Growth gives, lower wages gives even less spending. This feedback loop lasted years, then decades. Japan's government didn't sit idle. They launched massive stimulus programs. Trillions of dollars were poured into infrastructure projects, public construction, corporate bailouts, financial sector, or support. Bridges were built, roads expanded, cities modernized, but the problem wasn't infrastructure, it was confidence. People weren't spending, businesses weren't investing, banks weren't lending. The economy became dependent. Japan eventually became the most indebted developed nation in the world relative to GDP, and still, growth remained weak. Perhaps the most underestimated damage wasn't financial. It was psychological. An entire generation grew up watching stock markets fall, property prices decline, wages stagnate, job security weaken, young workers delayed marriage, delayed home ownership, delayed children. Risk-taking culture disappeared. Saving replaced investing. Safety replaced ambition. Economists now call this secular stagnation, when an economy loses long-term growth energy. Japan didn't just lose money, it lost momentum. Many experts ask, why didn't Japan recover like other countries after financial crises? There were several reasons. First, delayed action. Banks were allowed to hide losses instead of restructuring quickly. Second, political pressure. Powerful corporations and financial institutions resisted reform. Third, demographic collapse. Japan's population aged rapidly. Fewer young workers meant lower productivity and consumption. Fourth, monetary traps. Interest rates were cut to near zero. But even free money couldn't restart borrowing because confidence was gone. The economy became stuck in low-growth mode. Now here's where this story becomes terrifying. Because Japan's lost decade was not unique. It was a preview. Look around the world today. Massive money printing, asset bubbles in real estate and stocks, rising government debt, aging populations, weak productivity growth, artificially low interest rates. Sound familiar? Many central banks are now repeating the same playbook. When growth slows, print money. When markets fall, inject liquidity. When debt rises, ignore it, just like Japan did. The difference? Today's scale is global, which means the next lost decade might not belong to one country. It could belong to the world. Every financial bubble follows the same psychological pattern. 1. Cheap money creates easy profits. 2. Speculation replaces productivity. 3. Asset prices detach from reality. 4. Debt becomes normalized. 5. The correction exposes weakness. 6. Government. Let's finish with 3 lessons the world should never forget. Low interest rates feel good in the short term. They stimulate growth, boost markets, create optimism, but when used too long, they inflate bubbles and destroy financial discipline. Temporary relief often becomes permanent damage. Japan tried to avoid short-term economic pain. Instead of restructuring banks, they postponed reality. That decision turned a recession into decades of stagnation. Quick corrections hurt, but slow decay hurts more. You can print money, you can build infrastructure, but you can't force people to believe in the future. Once trust collapses, recovery becomes exponentially harder. Japan's lost decade wasn't caused by bad luck, it was caused by decisions, political pressure, monetary manipulation, delayed accountability, and now the world faces the same question Japan once faced. Will we learn from history, or repeat it on a larger scale? Because the next economic collapse may not come with sirens and headlines, it may arrive quietly, through slow growth, weak wages, rising debt, and fading opportunity, just like it did in Japan. If this breakdown helped you understand how global financial systems really work, hit like to support educational content. Subscribe for deep economic documentaries that mainstream media avoids. And comment below, do you think today's economy is heading toward a global lost decade? Your answer might reveal more than you realize.